Not only are mortgage rates inching up, any increase in the benchmark lending rates could lead to higher interest rates on car loans, credit cards, student debt, and more. Hampton Pearson explains.
Americans will run up nearly $47 billion in new credit card debt this year, according to a new study from CardHub.com.
I pay my bills all the time for that one card on time all the time, and always more than the minimum payment, and I cannot seem to pay it off.
Economists say if higher interest rates are coming, consumers will feel it first on those unpaid credit card balances.
The biggest worry for consumers is likely on their credit cards. That's where you're going to see rates move up probably fairly rapidly if rates continue to rise, which is a big if.
Low interest rates have made new cars more affordable. Auto sales were the biggest factor in better than expected retail sales in May, up 1.8% according to the Commerce Department, with concerns about higher borrowing costs fueling some of that demand. But leading economists say the auto industry will continue to offer creative financing incentives.
What's most important to them is not the size of the loan, but what their monthly payment is and how they can manage their monthly payment. And anything the auto industry can do to minimize that monthly payment has been able to sell a lot of cars.
On Main Street, interest rate concerns are not sparking anything like the market anxiety we saw on Wall Street this week. The one exception, college students and their parents worried about repaying all those loans.
You do want to get out of debt quicker. Nobody wants to have the feeling of actually having to owe somebody anything. So with student loans being as expensive as they are, I want to get them out of the way as quick as possible.
The one silver lining for consumers, gasoline prices are lower than they were at this time last year. As one person we talked to said today, we'll take anything we can get. For Nightly Business Report, I'm Hampton Pearson in Washington.